Hi. Okay, so you found a deal that you want to buy, or you're almost looking down on a particular deal that you want to make an offer for, and the thing you're going to need in place is the financing, right? So you want to do this process as early as possible. And when you're looking for deals, is if you've selected a market or an area that you're going to be buying a property in, is to reach out to the local banks in that particular area because they can give you some information as to whether they're going to how their terms and conditions for supplying financing, how that looks, etc. Starting the discussion, maybe looking for a loan broker. All of this work can happen in the background before you're ready to close on a deal, so that when you go to close, everything's already lined up. You don't want to be leaving the financing to the last minute. It can take time, and so we put together this little guide for you as to some of the things to consider early on in the process of finding a deal and buying your first self-storage facility. So you want to ask yourself, one, how much cash do you have right now personally? What are your assets? What does your balance sheet look like? Obviously, if you have millions of dollars in cash, it's going to be easier for you to then obtain financing. If you find that you don't have much cash, then you're going to have to get much more creative in putting a deal together. It doesn't mean you can't do it. You can do deals with none of your own cash. It really depends on how you structure things. You can, for example, bring in a partner who has the money, who's then the financial partner while you do the operations. You could raise money for your deal. You could potentially negotiate seller financing for your deal as well. There's different ways to close on a deal without necessarily just getting the bank and your personal savings and putting those in as a deposit. But it does help to take stock of where you're at right now. So it does help to just do that, step back, look at your balance sheet. What can you sell or liquidate to increase your assets? What can you do to improve your balance sheet as well? And you find that it looks like I'm not going to have any of the capital for the deposit, let alone all of the other expenses that come with buying a property. Then you need to, at this stage, be looking around so how you can potentially get that to help with the down payment as well. So once you know where you're at and realistically how much capital potentially you could raise or potentially get from a partner, you then want to work out what's a realistic size of property you can buy, assuming that a down payment is anywhere from 25% to 40%. If you've got $1 million in capital available to you as equity, realistically you might be able to buy a $3 to $4 million property. You also need to factor in the costs for the closing costs, which are on top of the down payment, and any other inspections that you need to do, as well as additional capital to improve the facility itself, and also for the operations and buffer capital too. So when a bank is going to evaluate you, they're going to look, do you have a strong enough balance sheet? So if you don't, you do need to bring that to the table. You can consider friends or family or contacts. You can also join some real estate networking groups as well. Because at real estate networking groups, what you'll be able to do is potentially find different people that you can partner with on a deal. Maybe you found a great deal, you can't take it down, you can offer it to them for a fee. Maybe you can find some form of creative financing. By having a larger network open to you, you can share strategies, share ideas, share deals, capital, everything to get the deal done as well. So there's many ways to get the capital for a deal, but you will need to start to think about that when you're actually approaching getting a loan from the bank, because they're not going to provide 100% loan for everything and your buffer money, etc. You're going to need to start those wheels in motion. So what are some form of financing that you can do? There's SBA loans. So a self-storage business is a business. So there is a small business association loan that you can potentially get to buy your facility. There's bridge loans, there's wrap notes, there's seller financing. There's traditional bank financing, the standard bank loan terms. There's the potential to lease purchase as well. There's hard money lenders. There's many different ways to get financing for a property. If you have the deposit down ready, then traditional bank funding is probably going to be your lowest cost of capital. The only one that's probably better is seller financing, right? If you can get really great terms with the seller on financing the majority of the property, selling it to you, but still carrying back the note, then that's going to be your absolute best deal, and also least risk too, because the worst thing that happens is that it reverts back to the seller, and you're not completely losing a huge amount of capital if you've managed to negotiate a small down payment with the seller. Your risks are down, and since they've sold to you, they're much more willing and more flexible. Banks, on the other hand, might be a bit stricter with their debt coverage ratios and their terms that they need for their loan. A seller is more likely to be a little bit flexible. The interest rate may be better. You might be able to get better terms. There's a famous saying: your price, my terms. If I say I'll buy, you want $10 million for your property, fine, I'll buy it for your property for $10 million. But my terms are I pay you $1 a year forever for 10 million years. You've got your terms, you've got your price, but I've got my terms. With terms, you can make a bad deal very, very good. If you're having to pay a very small amount of the property, it's amortized over a long period of time, that can juice up your returns, that can increase your cash flow and make a deal workable. So what could be a bad deal with traditional financing can be a great deal if you bring in a financial partner or you do seller financing, for example, too. So to get the bank loan, minimum credit score, and this of course varies between bank to bank. So that's why you do need to reach out to banks in the regions that you're looking to target assets to start to gather this information. But let's just say that a minimum credit score of 680 is what most of them are going to want. They were going to then want also a debt service coverage ratio. And what does this mean? It means that if your debt payment, your loan and your principal and interest payment is $10,000 a month, with a debt coverage ratio of 1.25, the property needs to be generating net operating income of $12,500 per month as a minimum. If it drops below that, the banks have rules where they can call your loan, essentially take the asset away from you. So you do want to make sure that the net operating income is far and above what you're going to need to pay for the loan, and that all starts with selecting a great deal with good revenues and lowering your expenses and keeping your profits high, because it makes it much less risky to take on debt if you have a very high coverage ratio. If you're bringing in 30,000 of net operating income profit every month and your debt is a $6,000 a month payment, your risks are much lower than if you're very close to the mark where you're bringing in 15,000 but your debt payment's 12,000. You've got very little cash flow, and there's a risk that if income dips, that you can't pay your full debt, your monthly payments, and that's the risk. So minimum down payment, we talked about that as well. So banks are going to want to see that one way or another. If you're going to traditional bank financing, they're going to look at your credit history. They're going to look at if you had any bankruptcies, tax liens, foreclosures. They're going to look at you as a person. And if you're going to buy the property as a business, they're also going to look at the business and any other people involved in that business too. So they're going to check your background. So you need to make sure that if you have had issues, then you might need to restructure into a partnership and have someone else take the lead in terms of being on the loan documentation. They're also going to look at your time in business. If you're just straight out of college, you just graduated, and you want to take a loan to build a self-storage business, the banks might not look favorable on that. But if you can show a 15-year track record of business success or career success, they're going to look much more favorably on that, as you're more likely to be a good bet. You're stable, you're a high performer, you're more likely to do well as well. If you've had experience in storage, of course it's even better, but it isn't a prerequisite for a loan. Having the right down payment, good background and good credit check and history, and then also the asset itself and the ability for the asset to pay the loan is critical when getting a loan. So when you're approaching the banks to actually get the final loan, what you're going to need is basically a loan package. There's a lot of documentation you're going to need to pull together, and it's a great practice to start pulling this all together and having this already well before you're ever going to need the financing in place. So things that you're going to need: your resume and business background. So basically, who are you? What have you done? Why should they trust you? What are some wins in your career? They're going to check whether you're a competent manager, a competent person. Of course, the more experience that you can show, especially relevant experience, the better. The statement of loan purpose. What will you be using the loan for? Where the proceeds of the loan going to be going? Then they're going to need, of course, all of the documents from the property itself. So you have the profit and loss statement of the property. Now, how it is right now is what they're going to be looking at, but also as stabilization. So what changes are you going to make, and how's it going to look in 2 or 3 years out, you know, once you've added maybe expansion units, if you've cut expenses. So you really want to have a current pro forma and a future stabilized pro forma, showing the cash flows, showing how you could actually pay that monthly debt down. You're going to want to see the balance sheet of the property and yourself, of course. They're going to want to see all of the financial statements for your personal, your holding company, if you're using a holding company, but also then for the property itself too. They're going to want the rent roll, the occupancy report, the unit mix, basically everything that they can then use to verify that the numbers you've put inside of your model, of your loan documentation, matches up with the reality of the property as well. Of course, you'll only have that when you're in negotiations with the seller, when you're doing due diligence. For now, you can prepare the majority of the balance of the work and then add to this your market feasibility study. So basically, it's when you're first approaching the bank and you've got a property that you're looking to buy, it definitely helps to have a market feasibility study. The banks will request their own appraisal, and they may have certain appraisers that they use to be able to give you the loan, to grant it. They want to, you know, the appraisal to value the property, that it's a fair price. A market feasibility study is in addition to that. It's basically a study done to analyze the demographics, the competition, the occupancy, the quality of the competition, the buildings. It's basically what we did earlier in the course in terms of choosing a site or a place to buy and then analyzing the competition, but in much more detail in a formalized report. It doesn't hurt to include this in your loan package. You're also going to want to know, the bank's also going to want to know, you know, what's the business that you're running here? Are you planning to buy one self-storage facility? Do you have other assets or investments in place? What's your goals with the property? What's your goals? What's your strategy with the property? You want all of that information in there as well, and you want a complete package of all of the information. And that's why we recommend trying to find a loan broker, someone who's experienced in this, to help you through this process. And a great way to meet all of these professionals is, of course, real estate networking groups, etc. In-person groups is the very best. You get to know people, you get to bounce ideas, you can talk about, and even if you don't know someone that can help you put this all together, you do want to have a meeting with a loan broker well before you actually go to the banks, because if you send this all off to the banks and there's anything that in there that really kind of makes you look bad, or maybe the deal doesn't look good as a result, then they may just, you know, in the back of their minds have blacklisted this particular deal or you as a person to back. So really, by having a loan broker in place first, going through it, sitting down, improving your loan package well before you go to the banks, then your chances of success are going to be much higher. And for the fee that they charge, they do provide an excellent service, because they may be able to get you better terms with their relationships than you could on your own too. So you're going to need to put together the full loan package, your business plan, you know, and you're going to have to allow time for the capital, to get the capital to close your deal as well. So if it's your first time borrowing, it may take longer to prepare everything. You're going to have to factor that time in and potentially look to extend the due diligence time with the seller as much as possible to allow yourself time to get the financing to close. If you find yourself in a position that you cannot get the right financing to close on a deal, you do still have options. I mean, you can get creative here. You can basically assign the deal to somebody else who can close. You can bring on a partner who can take on the responsibility of bringing the financing to the table, and you take a smaller equity share. It's not the end of the world if you can't get through this process, but of course you do want to scale your business, and the best way to scale and keep the most equity is if you're able to be the one who is arranging the financing too. So that's pretty much a quick summary of getting the financing for your deal. I know we haven't dived in depth into, say, seller financing or wrap notes, etc., because what we're trying to stick to here is the high level thinking that you need to execute on a storage deal, and with something like financing, there's literally thousands of hours worth of content that we can dive into as to things we can do. The main thing is if you don't have the equity and you don't think you can get traditional financing, then you need to look at getting creative in financing, and there's many ways to do this. And yes, you can buy self-storage facilities with seller financing, with financial partners, with other strategies as well. So it's just maybe more difficult or more tricky, but in the end the result's the same. You own the asset, and it may even be more profitable to get creative financing than traditional financing too.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.